A credit default swap, or CDS for short, is basically insurance for loans and bonds. Think of it as a safety net for lenders and investors. If you're worried about someone not paying you back, a CDS is a way to protect yourself from that risk. It's a contract between two parties. One party wants protection, and the other is willing to provide it, for a price. This is a common tool in the world of finance, but the basic idea is something we all understand. Imagine your friend lends someone a big chunk of cash, but they're worried about getting paid back. Maybe it's a loan to a neighbor or even a business investment. The risk is always there. What if the borrower can't pay? You step in and say, hey, if that person doesn't pay you back, I'll cover your loss. You're offering peace of mind, a guarantee that your friend won't be left empty-handed if things go wrong. Of course, you're not doing this for free. You ask your friend to pay you a small fee every year for taking on that risk. That's what a CDS is. It's a deal where one person pays for protection and the other promises to pay up if disaster strikes. Your friend pays you a yearly fee, just like an insurance premium. As long as the borrower keeps making payments, you keep collecting that fee year after year. But if the borrower fails to pay, if they default on the loan, you step in and cover the loss, just like an insurance company would after an accident or disaster. If the borrower pays back the loan in full, you keep the fee and move on. It's a win-win for you unless something goes wrong. In the real world, big banks and financial institutions do this with huge sums of money. Think millions or even billions of dollars changing hands. These contracts are traded on a massive scale, far beyond what most of us deal with in our daily lives. The market for CDS contracts is global, and it can have a huge impact on the entire financial system. Banks, hedge funds, and even governments use them to manage risk and protect their investments. For example, a bank that owns company bonds might pay another financial firm for a CDS, just in case the company can't pay back. It's a way to transfer risk from one party to another, making everyone feel a little safer. If things go bad and the company defaults, the CDS seller steps in and covers the loss. This helps keep the financial system stable, at least, that's the idea. But here's the twist. During the 2007-09 financial crisis, everyone was trading CDS contracts on super risky loans, especially those tied to the housing market. People were betting on whether loans would fail, and the market grew way too fast. When those risky loans went belly up, many CDS sellers couldn't pay up, and the whole system crashed. The domino effect was massive, leading to bankruptcies, bailouts, and a global recession. So, credit default swaps are like insurance for loans, powerful tools that can help manage risk, but also incredibly risky if used the wrong way. They can protect, but they can also cause big problems if not handled carefully.